Hello and welcome to yet another episode of The Crystal Ball. It really requires a crystal ball these days with what's going on in global and local markets. Such incredible volatility over the last few days. Pankaj Vaish of Citi is my guest today to make sense of all that's going around in the world of financial markets these days. Pankaj, good to see you again. I don't know where to start in the midst of so much action, but let me start with the Fed since you are an expert on those matters. As an emerging market investor, should you be happy, worried or confused at the message that came out from the Fed a few days back?
Hi Udayan, it's always a pleasure to be with you. I think the Federal Reserve clearly their non-tapering was a big sigh of relief for all emerging markets. But just for a moment to talk about from their point of view, I think they may have missed an easy opportunity. I mean, obviously from India's point of view, it's great, but the lead up to a tapering tends to be so difficult. And in the past, we've talked about how Mr. Bernanke at QE1, QE2 had talked about, oh, it'll only take us 15 minutes to reverse these actions. And actually it doesn't. It takes many, many months and it becomes very difficult. So this was just a demonstration of that it's so difficult to unwind these things. And I think this one was a sitter. I mean, they had prepared the market. There was a 140 basis point sell-off. A $10 billion was kind of built in terms of tapering. So I think they should have just taken it, because now to roll it back and with the new chairman to build the case again is going to be very difficult. So anyway, but you know, obviously they're very smart people. They know what they're doing. So they decided to do that. It was probably a missed opportunity. I think it'll be very difficult to rebuild. That crossed that threshold again. It just makes it that much more difficult. From India's point of view, for whatever reason, I think the swings around Fed tapering have just become too fashionable. I mean, just, you know, we were swinging around way too much. Whether they're buying 85 billion or 70 billion is not the biggest thing in the world, and certainly not for India. But yeah, for the time being, at least it was a major sigh of relief. And I think what people are betting on is that now the Fed may take a long time with the new chairman. It'll be difficult for them to get their nerve to do this. And so for all emerging markets and all risk assets, gold and equities, it was party time. I think that's how the market is reading it. So for India, certainly it's helpful for the time being.
Sure. Do you worry though, Pankaj, that the Fed may be stuck at this point? I mean, it probably is finding it difficult to exit, and at a time when US growth is once again beginning to just slip off the edges a little bit. Is it a dangerous mix which might have consequences for the future in terms of an overall global risk off if this continues and US growth disappoints a bit? I mean, that's been the strongest market of all. Do you think that could lead a bigger sell-off in global equities eventually?
Yeah, I think this was actually a good time for them to step in and start taking some of this liquidity away, because sooner or later it has to happen. And in some sense, once you've prepared the market, you've gone through the sell-off, it probably makes sense to take advantage of it, to rebuild this case. And I think you could almost see the guarded disappointment, in a sense, that even Dr. Rajan was exhibiting at the press conference, because I think everybody was prepared. It's like you're prepared for an inoculation shot, and then you're just told, okay, maybe it might be 2 months down the road. It was just disappointing in that sense. But anyway, I mean, it buys us some time. I think the Indian current account deficit, as he was saying, is in a much better shape given all the policy measures that they've put in, and hopefully it gives us enough time to be even better prepared. So that when it eventually happens, it's not as big a deal as it has been made out so far.
Do you see this emerging market rally extending then, Pankaj, over the next few weeks? Or do you think, I mean, India's rallied 20% in the last 20 days. I mean, do you think that captures most of this emerging market rally, or could it run on for a whole lot more?
I think broadly for emerging markets, it could yet run a little bit more. I think for India, this 20% in rupee terms and let's say almost 30% in dollar terms is very large. Even when we last spoke at the beginning of June, at the time of our conference, And my view, I was asked about the equity market, Indian equity market. My view was that we are broadly just going to be range bound. There's just not enough in the fundamental mix yet to take Indian markets to a new high, even though at that time there was a lot of bullishness out there. So I think we just need to get this house in order a little bit more. We need to make sure that the RBI, which is the biggest sort of participant to worry about or to take care of, we just need to make sure that we have full clarity and we know the road ahead. I think until that clarifies a little bit more what the road of rates will look like for the next 12 months, it'll be hard for the Indian equity market to get super charged up and bust out to a new high. I think it's good that it's come back because there was a huge amount of negativity. It's good that the policymakers swung into action and have announced a whole bunch of measures for inflows, which is the right way to deal with the rupee issue rather than the liquidity tightening measures that had been announced. So the equity market felt a little bit comfortable. For it to now bust out and make a new high, maybe at an index level it can do, but we know that beneath that, and certainly in mid caps and all that, we are very far away. So I think that's the true picture of the Indian market. We're not in a situation right now to be all systems go busting out into a new high. It's fair that we have come back a major way.
But can we say with certainty that low that we saw a few weeks back, 5100, will hold out? And do you see it, more importantly, being retested before the calendar is out?
Yeah, I actually was thinking that there was some danger of going even slightly lower. But those policy measures that were announced in terms of FCNRB and the Tier 1 capital borrowing, the oil swap, I think that was a huge sigh of relief, and that basically got markets comfortable that no more tightening measures will be implemented. The fear in the market basically has been, could this get much worse? Could they go from 10.25 to 12 to 15? I was asked by FIIs, crazy numbers, could they hike even more? And I think the fact that they moved in a different direction, which is frankly the more sensible way to do. I mean, I have opinions on the whole liquidity tightening measure aspect. This is a much better way to go, and I think that's what gave the market some relief. So I think yes, that 5100 should be the low. I think we are in a much better position now because the RBI has made it clear that they are not going down the path of further liquidity tightening measure. In fact, they're starting to roll them back. So that's a significant statement, and that repo rate will be the operational rate going forward. I think those are all very solid, sensible things, and that should give the equity market comfort.